So inflation is a very tricky thing because whenever you try to save money, your money is going to be worth less. So what exactly are you supposed to be doing if saving money is going to equal an outcome where, hey, my savings are actually worth less money? Am I supposed to basically save money? Am I supposed to invest into real estate, invest into stocks? What exactly am I supposed to do? And by the way, if you want to buy real estate, it becomes more expensive to go borrow money to do it because inflation, okay? If you want to buy stocks, guess what? Stocks during inflationary periods tend to go down in value. So it's kind of like this very tricky scenario where we're playing Monopoly with real lives and real people and real money, and it's not a joke. It's not funny. So in this video right here, I'm going to break down exactly what's going on with inflation and especially what do you do with your savings. And I'm going to show you exactly what I'm currently doing with my savings. And the answer is I divide it into several different things so this way I'm taken care of and I don't have to worry about basically I had so much money. Now this money is worth this amount and I can't even buy myself a candle. That's not what you want, okay? Now, as always, guys, like this video on top of also subscribe and hit the bell so you get notified. So the very first thing, guys, is this. Me and you, we can't control inflation. We don't control the Fed. We don't control any monetary policy, okay? And everything I'm going to tell you right now is based on Jerome Powell. If you don't know who that is, that's the chairman of the entire Fed, okay? So he does what he says he's going to do, and he's the person in control. So he's the person that can basically do what he needs to do to make things happen, all right? Sounds confusing? It's not. He's the person in charge of all this stuff. And here is the entire issue. Inflation is not a good thing because it could eventually cause a recession or, for example, a depression. And when that happens, we don't want that to happen because things get very bad, unemployment, and that's never a good thing. However, though, what the Fed does to control inflation is they play with interest rates. So whenever they make interest rates higher, it makes it more expensive for you and me to borrow money. Thus, we don't spend that much money on buying a new car, buying a house, starting a business, and all those other things. Basically, things tend to slow down. Whenever they lower interest rates and it becomes a lot cheaper for me and you to borrow money, well, we go out there, we buy a house, we buy a car, and we start businesses. So the economy kind of picks up a lot. But that also causes inflation. So the only way to lower inflation is to increase interest rates. That's all you need to know. So Jerome is saying, hey, we are going to do everything in our power to lower inflation. So to do this, they're going to increase the interest rates. That's all you need to know. That's what's going on right now. So whenever you hear CNN telling you this and that, we have this prediction, that prediction, no, the person in charge literally just told us exactly what he wants to do and what he's going to do and why he's going to do it, okay? That's it as far as what's going on with inflation. Now, here's what you need to consider when you're talking about, Tommy, well, what do I do with my savings? Overall, if you have a part of your savings that you want to invest, usually people consider these three assets, okay? First, stocks. Second, bonds. Third, real estate. There's also business, but rarely does the average person go out there and start a business, okay? That's very rare. But however, when it comes to stocks, we use, for example, the S&P 500. And that's an index that covers the 500 largest companies in the US. And when it comes to bonds, we use the 10-year note that shows us exactly how much the Fed is willing to pay us to hold on to a 10-year note of theirs, okay? Then third, real estate. We can use an index which shows exactly how much you can make from real estate. So overall, if you have money to invest, into which one of these assets would you want to put your money into? The first thing is, during inflationary periods, the Fed tends to raise interest rates, basically saying they're willing to pay more for their bonds. Right now, they're paying like 4.35% on a 10-year note. So that's actually awesome. However, though, think about this, okay? A bond is like a loan. It's like you're basically lending somebody money. So they're kind of issuing out debt. Meaning, for example, if they have $1,000 note and I buy a $1,000 note, I get paid 4.35% on my money. After 10 years, I get back my $1,000. That's the idea, okay? That's how it works. However, though, you can sell notes back and forth. The problem with this is basically that if you put your money in here and you believe that, for example, them increasing interest rates by X amount is not going to be enough to slow down inflation, and then they go ahead and basically increase interest rates again, well, your bond becomes less valuable because there are other bonds out there that are basically paying higher interest rates, okay? So that's something to do with the par value, but that's another video for another day. However, if they decrease interest rates, because basically inflation is coming down like crazy, then your bond automatically becomes a lot more valuable, okay? So it all depends on how you want to play this game. Second, though, you have, for example, the real estate market. Now, whenever you have inflationary periods, the idea is, well, real estate is going to protect me because the price is going to go up. In a way, yeah, it does go up. However, demand also diminishes and it goes down heavily. So in reality, if it becomes a lot more expensive for people to get a loan to buy a home because the interest rates basically go up, the answer is a lot less people are going to be buying homes. And whenever demand slows down, guess what? Although the price might be up, people might be willing to actually take on, for example, less than what it's actually worth in a sense. And that's when you have, for example, a buyer's market versus a seller's market. But overall, the last piece of the puzzle here is stocks. So stocks generally, since the Depression, okay, I'm talking about since 1929 to 2022, whenever we are right now, guess what? Have outperformed both bonds and also the real estate market. Stocks have made around 40% more than bonds, and I'm not sure exactly how much more than real estate, but it's averaged this index around 9.8. What is it? I think it's about 9.89% that the S&P 500 has actually gone up by, okay? So that basically means the best place to park your money is probably going to be into stocks. Although, okay, if you are doing it into an index, and here's why. If you put the money into an index, when the index is down, when do you want to buy it? When it's up or when it's down? The answer is obviously both, because you want to buy when it's at a discount and when it's selling also regularly. This is called dollar cost average, meaning if you are an index fund investor and you have, for example, some money that you want to invest, right now is a perfect time to go ahead and invest money, in my opinion, and here's why. Because if you're buying when basically the market is down, you're buying at a discount. And as the market goes back up, you keep buying and you keep buying and keep buying, but overall it keeps averaging out. And when it goes up, you're gonna have this big gain because you bought at the bottom. That's what I did back in March of 2020 when we had the whole pandemic and basically stock market crash. I bought a bunch of stocks back then, well, a bunch of like index funds back then, and it basically made me a lot of money because I bought it when it was down, because buying when it's down is a lot better than buying when prices are basically super, super high. That's the idea. So if you ask me, where's the best place to invest my money right now? I'm putting my money into stocks, okay? Because stocks have a history of outperforming bonds and also real estate. Now, to park your money, that's a whole different conversation, because if you're asking me, Tommy, well, what if I just have savings? You know, money that I have right now that I won't need for a while, but I need for something in the future, like buying a house, or for example, just to have the money saved over. The answer is simple. First, the only money I have set aside that is being eaten up by inflation is going to be my emergency fund. So that money that I have set aside in case anything happens to me, well, that money might take a hit to inflation, but overall, every month, I might just add a few dollars to adjust for inflation. So that right there is taken care of. And that's not an investment. It's just, for example, money for security. So a way to make sure you don't get eaten out completely is you can also put that money, for example, into a high yield savings account. So that way you have some interest going in there along with some of your money to kind of average out the cost of inflation, okay? Now, number two is if you have money that you're going to need for a transaction in the future, whether it's an investment or whether it's a property or whatever, the answer is you have to consider a few options. First, you have TIPS. Those are treasury inflation protected bonds or securities, whatever you want to call it. But overall, these securities are ones you can actually buy that they adjust their interest rate, what they actually pay you based on what the inflation actually is. So if inflation is 20%, you'll get 20%. If it's 5%, you'll get 5%. And it basically just averages it out. So that way you get the same amount of money you had value-wise, okay? Value-wise. Now, if you put your money into a note and then, for example, into like a treasury note, like a 10-year note, and then, for example, interest rates go up, then the par value of your bonds might might be worth less. And then that's a 10-year note. You probably don't want to do it. Now you can do it into T-bills, which are basically just 1 year, and that way you have 1 year and you don't have to worry that much. That's fine to park your money on the side into T-bills. That's fine, just 1 year. Or for example, you can just put your money into a high yield savings accounts, leave the money in there if you're gonna need the money in less than 3 to 5 years usually, okay? You're gonna take a hit, but it's better to take a small hit than to put your money into something you don't understand or might go down, or you're gonna need the money a lot faster. So me personally, the money I need, for example, to buy some real estate or to purchase some individual stocks, I'm not gonna put that into an index because I don't know how long the index is gonna stay down for, or if it's actually gonna go down lower, because that entire game is you hold for a long time. I wouldn't put money into real estate that might be, for example, inflated right now. You know what I mean? So it all depends. That's the answer. So overall, if you have money in emergency funds, keep the money in there. High yield savings, adjust for inflation by putting some extra money in there. If you have money you're gonna need in the next like 12 months, you can put it into a T-bill. And if you have money, for example, that you're gonna need in the next like 1 to 5 years, you can put it into a high yield savings accounts. And in reality, you'll take a small hit, but it's a lot better than putting your money into stocks or real estate or bonds and then making sure that basically you need to break that or sell that, and you sell it at the wrong price because basically you took a hit because you can't really predict what the market's gonna do. That's the answer, guys. And I hope this actually helps you. And overall, you don't have to keep looking at the news or anything like that. You just have to understand the basics. And the basics is when inflation is up, they raise interest rates to make borrowing money a lot more expensive. When inflation is super down and demand is basically not really that crazy, they make interest rates a lot lower to increase demand. It's like a whole game, okay? It's like a seesaw, okay? It's a seesaw. That's all it really is, okay? Now, see you guys next time. Thanks for watching. Like, subscribe, hit the bell to get notified. Comment down below any questions. You made it all the way here. Comment down below money so I know you made it all the way to the end of the video. On top of that, up here is another video. Over here is my face. Click subscribe. And as always, long-term team officially